Good afternoon, everyone. Welcome to Nova 401k Associates webinar on Washington Update. What does the 2020 election mean for retirement policy? Today's webinar is eligible for CFP, ASPA, and IRPA CE credit. Right after the webinar ends, you will see the survey pop up if you are needing one of these credits. We have also added the slides as a handout. Just click the handout drop-down on your GoToWebinar panel, and you can download and save the file to your local folder. Today's presentation will be presented by Craig Hoffman. Craig is an attorney/senior consultant with Nova, and for over 35 years, Craig's practice has focused exclusively on federal tax and ERISA matters relating to design, implementation, and operation of tax-qualified retirement plans. If you have any questions, please type them in the questions box, and if time permits, we will answer them at the end. Take it away, Craig.
Thank you very much, Andrea. Hello, everybody. It's good to be with you. We've got a very busy agenda. The title is, what does the election mean for retirement policy? And I'm going to look at two specific areas. The effect on legislation, in particular, the prospects for pension reform in this Congress, I think are pretty good. The Secure 2.0 is what the lead bill that was in the last Congress from the House side, bipartisan bill. So we'll look at that. Then we'll look at the Automatic Retirement Plan Act, which is a partisan bill that's largely the product of Richie Neal, chairman of the House Ways and Means Committee. That would literally mandate every employer in America of a certain size sponsor an elective contribution type 401k plan. We'll also talk about what's also in the news with all the GameStop trading frenzy and the like. There's talk once again about a so-called financial transactions tax. Bills have been introduced already in this Congress. There were several in the last Congress, so we'll talk about that. As time permits, I think we should have time, but we've got a full agenda. As time permits, we'll talk about President Biden's personal agenda, both from a regulatory side and really focusing on the DOL agenda at this point. That's where policy is being implemented, if you will. And then, again, if we have time, a legislative idea that has been floated as part of the Biden campaign. So without further ado, let's talk about the election. Obviously, we have a new president and new vice president. And so the White House is Democratic. The Congress itself is democratically controlled, but by thin margins. The House Democrats actually lost some seats in the last election, and so their margin of 21 is now down to likely 10. There are 4 vacant seats right now, 3 of which are likely to go to Dems. So a 10-person majority is not sweeping, even in the House. And then in the Senate, we have a 50-50 tie, meaning that any tie votes get broken by the president of the Senate, Vice President Harris, effectively giving the Democrats control. But as we know, it's not always as easy as that. Even when you have control, there continues to be discussions about the filibuster and its role in the Senate. And we'll come back to that in a moment. The point to be made is that with the House and Senate so closely, so little margin between the two parties, that tends to lead, frankly, to more bipartisan legislation getting through, because when there's deadlock and the filibuster is still there, we may well see much of what we've seen in the last term of Congress, with not much getting enacted. Obviously, if the filibuster is repealed by the Senate, that could change. But bipartisan legislation has appeal because it allows members of Congress to at least appear to be doing something on behalf of their constituents. And pension reform has always been a bipartisan endeavor. And the bill, the Major Secure 2.0, is jointly sponsored by Richie Neal and Kevin Brady, the chair and ranking member of the House Ways and Means Committee. What's interesting is how this will play out. The American Rescue Plan, which was the latest stimulus bill, was passed in the House and Senate under the budget reconciliation process. That was done that way because there's special rules that apply to budget reconciliation such that it cannot be filibustered, and it in fact was passed on a 50-50 vote with a tie break by Vice President Harris. And so that leaves a bad taste toward bipartisanship. And then there is a second reconciliation bill coming before Congress. It's the rare blue moon or whatever, because they never enacted reconciliation for the last fiscal year. That's what the American Rescue Plan was. They still have to do a budget for reconciliation for the 2021 fiscal year beginning October 1. And once again, there's talk that that will be a vehicle that the Democrats can push through their priorities with regard to taxes and infrastructure and climate change initiatives. And so there's a lot that could happen. And the point is there's going to be a lot of money that needs to be raised, and we need to be attentive to some of the proposals out there that might affect retirement plans that could raise monies that will not be used to benefit retirement plan policy, but to help pay for some of these other initiatives. An example of which was the House version of this last bill had a freeze on cost of living adjustments for 415 limits and for the 401A17 compensation, top comp limit. That was dropped by the Senate, and the final bill didn't have it, but that's something they could come back to. So if they are going to move ahead with retirement reform, where are they likely to go? And Secure 2.0, or the Securing a Strong Retirement Act of 2020, is the likely vehicle. It's a comprehensive bill, 36 separate sessions. The bill has not been scored for how much revenue it would cost the government in the form of foregone tax revenue should it be enacted. There are some provisions in here that are very expensive and could well be affected by the scoring of the bill. This bill was introduced in the last Congress. It has evaporated, if you will, because when the Congress adjourned without it being passed, all standing proposed legislation dies. So it will be reintroduced in this Congress at some time, and there's surely going to be changes to what was proposed, but much of what is in here has been on the table. I think 14 provisions are largely the same as was in a Senate version of Secure 2.0, the Portman-Cardin bill. So these policy proposals are likely to be included in some way, shape, or form in whatever we see as the next round of pension reform. So what does it have? It would mandate all 401k, 403b, and simple plans must automatically enroll participants, beginning at 3% and then an auto escalation of 1% each year thereafter, getting up to a maximum of 10%. If you have already established a 401k plan, you're grandfathered and don't need to add the automatic enrollment. And small businesses, church and governmental plans, as well as a new business, has 3 years before they have to add automatic enrollment. Now, this doesn't require anybody to go out and sponsor a plan. That's actually part of Richie Neal's Automatic Retirement Plan Act, but this would say if you've got one, it's got to include auto enrollment and auto escalation. The Secure Act gave us a larger new small business new plan startup credit, which is currently 50% of the administrative costs, up to an annual cap of $5,000, assuming you've got at least 20 non-highs. It's a function of $250 times the number of your non-highs, and that's for each of the first 3 tax years. Well, what this bill would do would raise it even more for smaller employers, i.e. those who have up to 50 employees, would get the credit increase from 50% to 100% of the expenses in the first 3 years of a new plan for a small business up to $5,000. And a small business here is one with 100 or fewer employees in the prior year who made at least $5,000 in compensation, the simple definition, simple IRA. It would also add a new credit for small employers, again, 50 or smaller, that would effectively pay for contributions for up to $1,000, 100% of them for the first 2 years, then 75% of the first $1,000 in the third year, 50% in the fourth, 25% in the fifth. Now, this provision only applies to defined contribution plans, not defined benefit plans, but it is an extra credit. And obviously, the incentive here of Congress is to increase the coverage of qualified retirement plans in smaller employers. And so for you all who work, a lot of you work, I know, with smaller employers, this should really be a helpful addition to the Secure Act credit increase that we already have. So it's good news. Then there's a fair number of clarifications, you might say, to Secure itself. Speaking of the new small plan startup credit, it would clarify that it applies when you join a MEP, a new. First time the employer is having a plan is when the employer joins a multiple employer type plan. The Secure Act legislation, the problem there is with the Secure Act as it is if a MEP's been around 3 years, that's the first 3 years of that plan. It also makes clear that the IRS, it makes clear that you look at the size of the participating employer that's joining and determining the eligibility under the small plan provision. What else? 403B would be permitted to be set up as multiple employer plans. That was arguably an omission in Secure when we're dealing with, again, this was arguably an oversight in Secure. There were efforts in Secure as it was in the final stages to add 403B plans, but it was too late. The cake was baked and it's left for another day, i.e. this bill. The bill would allow 403B custodial type plans to invest in collective investment trusts. CITs have been touted as a way to lower expenses. They have reduced costs because they're not a security. But to accomplish this, it requires a amendment to the securities laws of our nation, and the bill does that. And so, again, I think a lot of people have been anxious to see that provision be enacted. What else? RMDs. It would allow, once all your retirement accounts reached 100,000 or less, you can suspend any required RMDs as long as the account stays below 100,000 and you value it I believe, as of the last day of the prior year. Now, this is all retirement accounts, so a plan sponsor is not going to know whether the employee has IRA, rollover IRAs, or the like, and the bill provides that the plan administrator can rely on the certification of the participant that he or she doesn't have any other assets that would put him, when added to the plan assets, over that $100,000 threshold. The bill in the RMD area would go a step further than the Secure Act, which raised the required beginning date from 70.5 to 72, raising it instead to age 75. Now, that will cost an incredible amount of foregone tax revenue. The Secure Act change was a year and a half, and I think it scored I can't even remember at this point. It was a great deal of money in foregone revenue that had to be paid for someplace else. And that's where the stretch IRA was the pay for the changes made in Secure for this. And so the question is there going to be another pay for? That's something to be determined in the next iteration. 1042 exchanges. If I own a C Corp, privately held, I can sell my C Corp stock to an ESOP and roll over the proceeds into qualified replacement property, which is largely stock or other securities, and by doing so avoid having to pay capital gains on my sale to the ESOP. This would allow the same treatment for the owners of stock in a subchapter S corporation. Whoopee, it's good. It can't complain. This you can complain about. The long-term part-time employee rules were added by Secure. They were kind of a last-minute addition to what had been RISA before that. It was at the behest of Chairman Neal of Ways and Means, and it requires plans to permit long-term part-time employees to make elective deferrals once they've completed 3 consecutive 12-month periods with at least 500 hours of service. You can require attainment of age 21, and eligibility service doesn't have to be counted before 1/1/21. So this is rolling out what the Secure 2.0 would make a significant change, namely lower the 3 consecutive periods to 2 consecutive periods. And I'm looking for you. Here's my cheat sheet. Again, Chairman Neal is the chairman of the Ways and Means Committee. He sets the agenda. He put out at the beginning of this Congress his retirement security policy proposals, and on the list is to adjust the new part-time workers and 401k plan provision to only require 2 years of 2 years of service, 500 hours of service. So, and what's maddening is that this is added retroactively as if it was included in Secure to begin with. So I think this is going to be problematic, depending on obviously when it's enacted, but it's just going to bring those people in even sooner. Student loan repayments. Right now, if there are some programs out there, but they're not really, they fit within different nooks and crannies than typical matching contributions to a 401k plan. They're not matching contributions. They're tested like profit sharing contributions. The bill would change that so that if an employer wants to make matching contributions to its 401k plan that match student loan repayments made by their employee, the bill would sanction that and treat those matching contributions like any other matching contribution, which would be tested as part of the normal actual contribution percentage test that look at the disparities between the highly and non-highly compensated averages. and it could be done in a safe harbor plan as well. So I think there are ways to do it today, even without this provision. And we've seen some people adopt that. It's not that hard if you have the right demographics, but this would make it a lot easier. Oh, electronic communication, another interesting area that's been fraught with disagreement. The e-disclosure regs that came out from DOL were not the favorite of many organizations, including among them AARP, who is concerned that seniors will not be able to access the internet and otherwise get their notices. There was also lobbying done for the Coalition for Paper Options, which included such fine organizations as the Printing Industries of America, the American Forest and Paper Association, the National Association of Letter Carriers, Hallmark Corporation. All of these folks are interested in paper and having notices mailed to help the post office, if anything else. In any case, the e-disclosure regs are final, and they may be revisited in some way, shape, or form in the new administration. What this would do is overrule those regulations by mandating under statute that employees get at least one quarterly benefit statement in paper each year that makes it clear that they can elect to get paper. They can elect out of the paper statement. For DB plans, it would be once every 3 years. So that fight is continuing. EPCRS, the Employee Plans Compliance Resolution System, is a great program. It's been around 25 years. The IRS has made improvements to it over the years, but it could always be better. Congress has directed them in the past to make improvements in certain areas. This bill is no different. Now, this first direction is more than a direction from Congress. It's actually encapsulated in the Internal Revenue Code under new section 414AA, but it will mandate that the IRS allow plan sponsors to correct reasonable administrative errors that occur in implementing automatic enrollment or automatic escalation. The fix must be corrected within 9.5 months after the close of the plan year in which the error occurred, and it's got to be done in a manner favorable to the participant and non-discriminatory, whatever that means. The IRS does have to write regs, but they can't ignore Congress when they put it in the code. Now, EPCRS today, well, I shouldn't say today, up until December 31, there was a similar provision in EPCRS that allowed you to self-correct under these auspices. And the 9.5 month deadline is based on the normal 5,500 extended due date when by which time most auto enrollment errors will be caught. So this dovetails with what EPCRS was currently doing, but that expired December 31. It was a transitional safe harbor. A new and improved, completely restated RevProc on EPCRS is due out any moment. I understand it's in clearance at the IRS, and I very much expect them to continue what's already in EPCRS, but this makes it clear they don't have any choice. What else? There's a lot of direction to expand EPCRS. Here it's not in the code. Basically allowing self-correction indefinitely unless you get pegged for an audit. It has to be a so-called inadvertent qualification failure that isn't egregious, it can't be with regard to the diversion of plan assets or a tax avoidance transaction. but it basically gives a much longer self-correction period than the 2-year period we presently have under existing EPCRS procedures. And Mike Applepie put out more safe harbor correction examples, treat loan corrections as automatically satisfying the DOL VFCP program. Right now, you've got to go through the IRS program in order to satisfy DOL. DOL is themselves supposed to be putting out a new and improved voluntary fiduciary correction program that might address this of its own initiative. We'll see. Basically, again, direction. We have to wait for the IRS to actually implement that. The bill directs IRS, DOL, and PBGC to get together and 18 months later come out with a report that would make our notices better. Good luck. Anything that has 18 months to get a report that then has to lead to some kind of legislation, I hope I'm still around to read it. Let me just put it that way. Another provision, though, that many, when I was at ASPA, we were pushing for, and that is it would permit plans to not have to send notices to participants who are eligible but do not have any account balance. They are participants under ERISA as such, and this bill would say, okay, for those folks, you need to send them an annual notice, but the quarterly statements, any blackout notices. Obviously, if I don't have any money, a blackout notice isn't going to apply to me in the plan. I don't have any money in the plan, so it's a good thing. What else? Oh, okay. For my advisor friends tuning in, this is a solution to, I believe, from what I've heard, to targeting with advisors is a problem that's really not that big a problem at this point. When the DOL regulations came out on participant benefit statements, they require that there be disclosed a benchmark to any directed investment alternatives that's based on a broad-based securities market index. And the DOL has interpreted that as precluding the use of any mixed asset class kind of benchmark, which would be more helpful for a target date fund rather than a S&P 500 index. The bill would finally direct the DOL to modify the regs so you can have a mixed asset class benchmark. So I think it will improve the benefit statements, but I'm not sure people have been pining over what we've had to deal with over the last, 10 years we've had the 404C disclosures. Would establish an office of lost and found in the PBGC. This has been pushed by Elizabeth Warren in separate standalone legislation as well. It would basically take information that's already being submitted to the IRS with regard to terminated participants who have a vested account balance. It would probably beef that up a little bit, but the idea is they would set up a database that could be searched by participants to find out where their money is. You're not sending your money to the PBGC. You're just telling them whose money you have, and then it's going to be up to PBGC to create the database, which should, in the eyes of Congress, they're giving them 2 years to get it going. Again, I don't think we can complain about this. Quite honestly, all of this is good stuff. Most of it, I'd say, is good stuff. There are a few, lemons in the mix, but what else? 457 plans. You are required to make your deferral with regard to compensation before the month in which you are going to be, the beginning of the month in which it's going to be paid. This would change it to before the date it's going to be paid, just like the 401k rules. So the bill as written in the last Congress was effective for plan years beginning after 2021 or 2022. Well, expect that to be at least moved back a year or two, depending on how this plays out in the current Congress. The intention, I think, is to give at least a year or two to get ready for it. We'll see. Like many bills that we've seen, it allows plans, it gives a delayed amendment deadline, provided you operate in accordance with the new law and that your amendment reflects the manner in which the plan was operated during that interim period. Deadline for amendments is 2022. Again, that'll move out 2 more years for governmental and collectively bargained plan. And again, as I said at the start, this is the framework. The actual, bill, the reintroduced bill, is going to be the subject of a fair amount of lobbying that is ongoing with regard to the bill and to improve it and otherwise, ameliorate perhaps some of the more troublesome provisions. And as I mentioned, 14 of the provisions are essentially the same as the Retirement Security and Savings Act, which was also introduced in the last Congress by none other than Rob Portman and Ben Cardin. At least 14 of the provisions of the bill are essentially the same. And so how this plays out, the original thought, frankly, was that this would be something Congress would address early in the new Congress, but that was when there was an expectation that or belief anyhow, that the Democrats wouldn't necessarily have both the House and the Senate. The politics that have played out has resulted in the pressing forward of less bipartisan agendas, as is reflected in the American Rescue Act that was put through on a strict party line vote. So it may take a little while for tempers to wane, and it's not too early to mention that we have a midterm election in about 18 months. And the 2022 midterms are going to be very interesting. The Democrats have 14 seats up for re-election. The Republicans have 20. There are about 8 competitive races. A number of Republicans have indicated they're not going to stand for re-election in states that are purple. I think of Rob Portman in Ohio, where there already is a Democratic senator. Tim Scott is up for re-election in Florida, and Florida can be purplish. So the point being is things could change. Congress will want to get something done when they go out campaigning for the midterm elections. Bipartisan legislation is typically that. It may get pushed to that, till next year, but it's going to come up. And it's it's good to know what's coming, so that if you have any interest or thoughts on provisions in the bill, it would be worthwhile for you to reach out to your members of Congress with your thoughts. It really does work. If anybody needs some help with that, please feel to shoot me an email. I'm happy to assist. I spent 10 years as general counsel for ASPA, the American Retirement Association, and I certainly wasn't their #1 lobbyist. I was the tech geek, but it was a fun time. Anyhow, moving on. The Automatic Retirement Plan Act. This is a more partisan bill. It's the policy initiative of Chairman Neal. Again, that was his third priority for retirement policy is to implement automatic IRAs in 401ks. And this is what does this. And time will be going as we get near the end here. President Biden had as one of the potential elements in his on his campaign website toward retirement matters was to require an automatic IRA type plan, which this is really would likely be the substitute for it because it allows either IRAs or 401ks. Richie Neal never introduced this bill in the last Congress. The COVID messed everything up with their timing, the dealing with the COVID emergency. And so what he did do on November 12th was release a discussion draft to interested parties, lobbyists chiefly, and the intent really was to put it out there to give folks the opportunity in the community to provide input. So that is ongoing, and so once again, I expect this to be introduced and maybe considered, if not this Congress, maybe next Congress, particularly depending on how the 2022 midterm election goes. So what would this ARPA do? It would require all employers to sponsor either a 403B, a 401k, a payroll deduction IRA, or be sponsoring a grandfathered plan. Now, a grandfathered plan means basically any qualified plan or similar to a qualified plan that's been in existence for at least 1 year prior to the date of enactment. So those plans would not have to add a 401k feature necessarily. If they have a 401k feature, the expectation is they would have to automatically enroll people. They'd be subject to the long-term part-time employee rules. So the grandfather plans aren't necessarily escaping completely here, if you will. But otherwise, you would have to have a plan unless you were a small employer, less than 10 employees, new employers, you have been in existence fewer than 3 years, and churches and governmental entities. So this is a mandate, and keep in mind, the Congress has been considering this type of a mandate for a number of years. It was introduced in 2017. I think the earliest version was 2015. I may be mistaken there. But it's never gone anywhere because it's a mandate, and the Republicans opposed it entirely, on the basis of the arguments made over the Affordable Care Act. I think some of that has changed, partially because the states have embarked upon mandating essentially a similar requirement on a state-by-state basis. And at this point, there are some who believe it would be better if we just had one federal mandate that applied uniformly across the country. And so the opposition of perhaps traditional business groups is not as fervent as it once was. So, and from a policy perspective, I would say if you're working with retirement plans and employers have to have one, I don't think we should complain. I'm just saying. Who has to be in the plan? Anyone over age 21 who's completed either 1,000 hours of service or 2 consecutive 12-month periods in which they had at least 500 hours of service credited. Excuse me. So it's similar to what is being pushed with regard to the long-term part-time employee rules. You could exclude employees who are under a collective bargaining agreement where retirement benefits were subject to good faith bargaining, and non-resident aliens as long as they have no U.S. source income. This mandatory 401k plan would have to include a lifetime income distribution option, which is available for 50% of the vested account balance. This is probably an area that needs some work. There are many who believe this would be problematic, that the market is not developed enough to purchase this kind of a product. It could be an in-plan distribution, which would be crazy in a DC plan, or it could be an annuity, option made available at termination. In any case, again, the push policy reason here is to encourage people to take more of their retirement money as a steady income stream that's not subject to mortality risk or investment risk. This 401k plan generally must be invested in a qualified default investment alternative in accordance with the DOL reg, unless the participant elects otherwise. It's got this crazy reasonable fee tax qualification requirement. And I just think it's so funny, I had to quote it directly from the bill. Quote, under the fee requirements of this paragraph, no participant may be charged unreasonable fees solely on the basis that the participant's balance in an automatic contribution plan is small, or solely on the basis that adoption of such a plan by the employee's employer is mandatory. So I know what they're getting at, but if you read it for what it says, no participant may be charged unreasonable fees solely on that basis. So if you have a different basis to charge unreasonable fees, maybe that's okay. No, it's not. It's just, sorry. Anyhow, the first version of this made that applicable as a qualification requirement to all plans. In my prior life at ASPA, we were successful in counseling that we don't want IRS agents doing audits determining whether a fee is reasonable as part of a qualification compliance audit. That's what DOL does under ERISA, and so the discussion draft that was released in November applies this reasonable fee requirement only to plans that are not otherwise subject to ERISA. It adds a new deferral-only arrangement, which can be used to meet this mandatory 401k plan. It's a simplified, essentially, 401k plan. Elected deferrals are capped at $8,000. No employer contributions are permitted or required. There is a $1,000 catch-up. It would be exempt from any 401k testing. There's no matching contribution, so there's no 401k test, but remember, there's only an $8,000 contribution limit. It would also require automatic enrollment, where you would enter the plan for that first year, partial year you enter, and the full second year at 6%. Then you go up 1%, auto escalate each year to where you reach 10. And then every 3 years, the plan must automatically enroll anyone who is not at the percentage they would otherwise be at given their years of participation. What's interesting is this mandate. This is under the qualification requirements. And so the mandate to the employer, to force the employer to do this, is an excise tax of $10 per day per employee who is not automatically enrolled in one of these plans during the compliance period. Now, it's limited to 3 months or $900 per employee, but depending on how many, it's the maximum for any year is $500,000, which is a chunk of change. There are a bunch of exceptions built in on the excise tax, ability to correct. We'll see. I mean, unfortunately, or it is what it is, you got to rely on the IRS in dealing with the application of this excise tax, and how willing they will be to provide the exceptions remains to be seen. All right, quickly here, time. We've got 15 minutes left, so I think actually we're in pretty good shape. The Wall Street Tax Act, or the Financial Transaction Tax. This says been proposed several times over the last 10 years. Other countries have tried it. The state of New Jersey, I think, is still considering it. And the idea is this generally comes from the progressive side of the political spectrum, where the goal is to target, in their mind, unproductive and speculative trading of securities. And this recent retail investor mania in stocks, the Robinhood crowd. Oh, Siri, got my don't. What? All right. Sorry about that, folks. Siri started talking to me on my watch, and I didn't talk to her. Very rude. Anyhow, as I was saying, the Robinhood stocks has caused folks to once again talk up the idea that we need to look at a financial transaction tax. And in fact, CNN Business reported a unnamed White House official to say, quote, the potential impact of financial transaction tax on GameStop-like trading deserves additional study and can be part of a greater evaluation of such a tax for revenue and market stability. So what would it be? Well, the prior bills, as I said, have been introduced by Senator Sanders, Elizabeth Warren. Peter DeFazio is the first to the starting line in this Congress in the House, introducing the Wall Street Tax Act of 2021. But they all essentially do the same thing. They place a tax equal to 0.1%, 10 basis points, on each financial transaction in which a security is bought or sold. And securities include, the long list of what's on your screen: stock, partnership, notes, bonds, debentures, derivatives. And this is really, obviously, can mount up to a great deal for, the high-speed traders, which is who it is aimed at. But prior iterations of these bills have provided an exception for securities bought or sold through a tax-qualified retirement plan. And this bill does not do that, nor did the bills in the last Congress. And so every time a participant makes a contribution, rebalances his or her portfolio, or a mutual fund that the participant holds itself makes a trade, this transaction tax is going to be levied essentially on somebody's retirement savings. The middle America, not the highfalutin, high frequency trading hedge funds. And so understandably, folks have raised alarm about the potential impact to the retirement savings of Americans. The tax would raise $60 billion is the estimate. And so again, it may be in play, maybe not this Congress. It may be next Congress, depending on how the midterms turn out, but it's not going away. And that unnamed White House spokesman said we're going to look at it. Doesn't mean, I don't believe we've heard yet whether President Biden would support such a tax, and whether it might be included, for that matter, in a major tax policy bill that could be rammed through Congress as the second reconciliation bill this year. Clearly, there's a desire. There is going to be a tax element to that second reconciliation bill. What is in it remains to be seen. And so, moving on, what do we expect? Let's hit the regulatory policy from we're seeing at DOL from President Biden. On Inauguration Day, as is the tradition of all incoming presidents replacing an outgoing party, Ron Klain sent out a memo telling every federal agency, stop what you're doing until we get somebody appointed to look at what you're working on. if any regulation has been sent to the Federal Register but not published, withdraw it. If it's been published but not effective, consider delaying its effective date. So that was, the order from Chief of Staff, and understandably why it came out. In the closing days of the Trump administration, it was very clear that federal agencies throughout the government were endeavoring to get as many of their regulatory projects to the finish line in case President Trump was not reelected. And it is much more difficult to undo a regulation that has become effective than one that hasn't been issued or is hasn't become effective yet. If a reg is out there and it's on the books and effective, then you have to go through the rulemaking process as dictated by the Administrative Procedures Act to justify why you are issuing this regulation. You've got to give notice to the public. You've got to take comments, have to consider those comments, have to do an economic analysis. Much tougher. And so it is the tradition of many administrations, if they're expecting to go out of office or worried about it, to get their reg projects done before a new president might take office. And so high on the list for DOL in the old administration was dealing with the Obama administration investment advice regulation, the fiduciary reg. And actually, when the Trump administration came in, they did put a hold on the fiduciary reg while they investigated it. And in the meantime, the Chamber of Commerce successfully got the Fifth Circuit Court of Appeals to vacate the regulation, which means it's like it never existed. And as a result, the DOL under the Trump administration did not appeal that Fifth Circuit decision to the Supreme Court, and bingo, the Obama reg is gone. On December 18th, the Trump administration, as they were going out, issued a class exemption, the final class exemption, dealing with investment advice fiduciaries and the manner in which they can receive compensation from third parties. And it essentially, to be very honest, it was very similar to the best interest contract exemption that was the brainchild of Phyllis Borsey and the Trump administration. That was operated under the old fiduciary reg that was vacated. It's very similar. It requires a best interest standard. The one thing it does not have is the mandate that it be pursuant to a written contract, which means that it shields that the enforcement of that contract from a potential private class action suit. So that's what it does. And as part of the release of that exemption, the class exemption, there was a lengthy preamble in the proposed reg setting forth the DOL's position and basically reinserting the 5-part test of prior regs, the participant education interpretive bulletin. That's not investment advice if you meet the rules of that 96-1, reinstated them. And the one noteworthy point in the preamble was that the DOL indicated they were abandoning their position in the Desiree letter that if you're not already a fiduciary, giving a rollover recommendation to a plan participant doesn't make you a fiduciary. They now have adopted the view that if it otherwise meets the 5-part test, that rollover recommendation will be subject to the fiduciary obligations of a fiduciary. And so where do we stand in the Trump administration? Quickly, they issued a news release just last month saying the final class exemption would take effect as planned on February 16th, but they also said the temporary enforcement policy will remain in effect until December 20th, 2021, and essentially saying they will continue to allow folks to operate in good faith, but they are also going to reach out to stakeholders to determine if there should be further ways to improve the exemption. Expect that to do that, they've got to go through a full-blown rulemaking regulatory process. That's going to take time. What else? Now, speaking of non-enforcement policies, quickly, the DOL put out two regs on environment, social governance factors, ESG regulations. For environmental, social, and governance considerations, the DOL said the only thing plan fiduciaries should consider is the pecuniary benefits to the participants as far as the financial return. It didn't come right out and ban ESG, but it made it very difficult to take that into account. Proxy voting regs basically came out and said you should only spend money and vote proxies on issues that affect, again, essentially the financial return of the investment for plan fiduciaries. And all of these were overturning sub-regulatory guidance in the Obama administration. The Trump administration wanted to make them more lasting. They did them as regs. On January 20th, President Biden issued an executive order to consider for review regs that are inconsistent with the promotion and protection of public health. On March 10th, 2 weeks ago, DOL said it is adopting a non-enforcement policy with regard to both sets of regulations. So they're not going to go out and take any fiduciary to task for considering ESG factors. With that said, the DOL intends to revisit these regs, and it should be pointed out it's one thing for the DOL to announce they're taking a non-enforcement policy. That does not bind a private litigant who could sue in a class action lawsuit, if you will, for the violation of the regulations as they exist. It is also possible both of these regs could be challenged under the Administrative Procedures Act and be vacated because of that. What else? We're going to get guidance on pooled employer plans. Well, they're working on it. Let me talk to finish very quickly. As I said, automatic retirement plans, probably President Biden would be interested in. The other major structural change is to do away with the current scheme of taxing qualified retirement plans, where an employer gets a deduction or an employee gets an exclusion for contributions made on his or her behalf. That effectively saves that person, the fact that it's not includable in the income of the employee at the time when made, saves the person the equivalent of his or her marginal tax rate in taxes due that year. So if I'm a single taxpayer making $600,000 and I put $10,000 into my 401k plan, I save $3,500 in taxes. A person making $60,000 would only save $2,200 because they're only in the 22% tax bracket. I'm going to skip through. The centerpiece of the proposal is to do away with that deferral of income tax on contributions. So they would be taxed right up front, and it appears they would be then ultimately taxed when withdrawn, much like after-tax employee voluntary contributions are taxed today, where some portion that comes out will be a return of principal tax-free, and the earnings generated while invested will be taxable pro rata as amounts come out. But the revenue generated by this would be incredible. And what it would do Okay, this is where, I'm sorry, I'm going quickly. What it would do is be replaced with a tax credit equal to some percentage of the contribution. The number thrown out is 26%. So going back to my individual making 600 grand, they'd save 2,600 in taxes, but the individual making 60,000 would save that same 2,600 in taxes. Needless to say, many owners of small businesses would likely be disincentivized, perhaps, from having a plan by virtue of that change. We'll have to see. As I also mentioned, it's possible we may see frozen 415 and 401(17) limits, as we saw in the Senate bill, as a way of raising money in the weeks ahead. I think the Biden proposal is likely, again, as far as converting to a credit, is going to need a stronger Democratic majority in both houses of Congress. Whether that happens in 2023 in the new Congress then or not remains to be seen. I am right at my marker of 6 o'clock on my time clock, 5 on yours Central. You can do the rest wherever you may be. I hope you enjoyed it. We are going to try and do these with an advisor kind of focus periodically. We're not quite sure of what the schedule will be, but be sure to stay tied into our contact list, and we'll follow us on Facebook and do LinkedIn, all those good things. Thank you very much. Andrea, please take it away.
Thanks, Craig, and thanks everyone for joining us today to talk about the Washington Update webinar. Please note there will be a survey that will pop up right after the webinar ends for you to complete if you need CFP, IRPA, or ASPA CE credit. So just be on the lookout for that. Also, specifically, if you need CFP, it is very important that you complete the survey to get credit, as we'll need the last 4 of your social and your CFP ID number. All certificates will be sent out in 1 week, and the recording of this webinar will be made available on our NOVA YouTube channel by the end of next week. If you have any questions, please email webinars@nova401k. And with that, we hope everybody has a terrific Thursday.